Did you know that a diversified portfolio can be the difference between weathering a market storm and getting caught in it? In this video, I'll show you how to build a stock portfolio that can withstand market fluctuations, grow steadily, and help you achieve your financial goals in 2025. Stay tuned. Hey everyone, welcome back to SmartCoin Chronicles. If you're new here, be sure to hit that subscribe button, because today, we're diving deep into something that can help you grow your wealth and protect your investments building a diversified stock portfolio. Whether you're just starting or you've been investing for a while, having a well-balanced portfolio is essential. So, let's break it down in simple terms. Why diversification matters. Now, what does diversification even mean? And why does it matter? In simple terms, diversification is the practice of spreading your investments across various asset classes, industries, and geographic regions. By doing this, you reduce the risk of putting all your eggs in one basket. Imagine this: if you invest everything in a single stock, you could face huge losses if that stock performs poorly. But if your portfolio includes a mix of stocks, bonds, real estate, and more, the impact of a single bad investment is much less. Think about it like this. Remember the market crash in 2008? Investors who had their portfolios diversified with a mix of bonds, stocks, and real estate had a much better chance of weathering that storm. So, whether the market is up or down, diversification can help keep your portfolio stable in the long run. Understanding different asset classes. Now, let's take a look at the different asset classes that you can diversify into. 1. Stocks. These are equity investments where you own a piece of a company. Stocks have high growth potential, but they also come with higher risk. Picking the right stocks is crucial. 2. Bonds. Bonds are essentially loans you give to governments or companies. They're considered less risky than stocks and provide regular interest payments. They balance out the risk in your portfolio. 3. Real estate. This includes direct property investments, or REITs, real estate investment trusts. Real estate often performs well during times of high inflation and offers a steady income stream. 4. Commodities. These include things like gold, oil, or agricultural products. Commodities can be a good hedge against inflation and add some stability to your portfolio. 5. Cash. Holding cash or cash equivalents like money market funds gives you liquidity and safety, but it doesn't earn much interest. It's your cushion in case the market takes a downturn. Now, you don't need to be an expert to get started with these. The key is knowing that each asset class has its own risk and return characteristics, and balancing them in your portfolio will help you achieve your financial goals with less risk. Building your portfolio. Step by step, let's move on to building your portfolio. Where do you start? 1. Determine your investment goals and risk tolerance. Are you looking to grow your wealth over time? Or do you need income now? Your risk tolerance will determine how aggressive or conservative your portfolio should be. 2. Selecting individual stocks and bonds. When choosing individual stocks, think about things like the sector, size of the company, and style, growth vs value. For bonds, consider the credit risk, interest rates, and maturity. Don't put all your eggs in one sector, mix it up. 3. Consider low-cost index funds and ETFs. If you're just starting out, ETFs and index funds are an easy way to get broad market exposure without picking individual stocks. These funds give you exposure to a variety of sectors and companies all at once, making diversification a breeze. Rebalancing your portfolio. Now that you've built your diversified portfolio, it's important to rebalance it regularly. What does rebalancing mean? Rebalancing involves adjusting your portfolio to maintain your desired mix of assets. Over time, some of your investments may grow faster than others, and your portfolio may become unbalanced. You'll need to check on your portfolio at least once a year, or whenever there's a significant change in the market. For example, if stocks have performed well and now make up a larger portion of your portfolio than you'd like, you might sell some of those stocks and buy more bonds or other assets. The key to rebalancing is to stay disciplined and avoid emotional decisions. Don't try to time the market or chase short-term trends. Investing for the long term. The most important aspect of building a diversified stock portfolio is thinking long term. The market will go up, and it will go down, but over time, the trend has historically been upward. By staying invested for the long haul, you allow your investments to compound. This means that your money works for you and grows over time. Don't panic during downturns, and remember that staying disciplined and sticking to your plan is the key to success. Think about it. If you had invested in companies like Amazon or Apple 10 years ago, you'd have seen incredible returns. The earlier you start, the more your money can grow. So, to sum up, diversification is essential for reducing risk. Rebalancing keeps your portfolio on track, and long-term investing lets compound interest do its magic. Remember to make sure your portfolio aligns with your goals and risk tolerance, and you'll be on the path to building wealth. Thanks for watching this episode of SmartCoin Chronicles. If you found this video helpful, make sure to like, subscribe, and hit the bell icon, so you don't miss any of our future content on personal finance and investing.